Welcome back to Cyber Trading University. My name is Adam Rose, and I'm very happy you could join us here today. We're going to have a very fun discussion about, well, I think one of the most useful tools in the Forex market, also known as Fibonacci. How many people here are familiar with the Fibonacci retracement tool? Just want to take a quick poll. Excellent. Excellent. Great to hear. A lot of yeses. Well, this, I hope, will act, this will serve as either a good review or, hopefully we're going to be able to take something new away from this presentation as well. The Fibonacci tool, I think, works especially well in the Forex market just due to the enormous volume that goes through the Forex market every single day. Over $4 trillion a day that goes through the Forex market. Most of that capital goes through the 8 major currencies we trade, such as the euro and the dollar and the British pound, etc. Because of that great, tremendous amount of volume, the technical indicators that we use, I believe, are just that much more representative of the true prices. Now, please take a moment to take a look at our Cyber Trading University risk disclosure. We also have this available on our website as well, cybertradinguniversity.com. It's always important to know that trading the Forex market, like any market, involves a certain amount of risk, and we should always certainly be aware of that risk when trading any financial market for that matter. Now, quick note about Cyber Trading University. We've been an educational trading institution since 1995. It's established itself as a leader by first working directly with the SOEs, the SOES trading firms, teaching them how to day trade. Cyber Trading University was one of the first to establish itself as a quality stock market trading school. Each of our instructors has a minimum of 6 years of actual trading experience before they begin to work with students. Over the past 14 years, we have taught thousands of students to become successful and profitable traders. And of course, our headquarters are located in the heart of the trading world, New York. All right, it's a 2-day event. Tomorrow, we'll be talking about day 2. Day 2 is tomorrow. We'll be talking about the Fibonacci tool as it applies to the live market conditions, putting the theory to practice. But let's start from the beginning and take a look at Fibonacci. What is Fibonacci? Why is it best suited for the Forex market? How do we use it to trade the Forex market in terms of retracement and extensions? We can also use Fibonacci in conjunction with many other indicators and oscillators. Fibonacci exists in the most common chart patterns that we talk about every day. And Fibonacci is also certainly a crucial part of the Elliott Wave theory, which is one of my favorite things to talk about when we talk about trading. And then, of course, we certainly can apply Fibonacci to live market conditions. But starting from the beginning, it was discovered by Leonardo di Giulio, also known as Leonardo Fibonacci from Italy, considered one of the most talented Western mathematicians of all of the Middle Ages. Now, this is the way it works. Good morning, by the way. Starting with a 0, we add 1, and then we proceed to add the 2 previous numbers to generate the next integer in the sequence. So 0 plus 1 equals 1, 1 plus 1 equals 2, 2 plus 3 equals 5, 3 plus 5 equals 8, so on and so forth. The Fibonacci ratios are derived from the relationship between the different integers within the sequence, meaning the difference between 1 to 2, the difference between 2 to 3, 3 to 5, 5 to 8, 8 to 15, etc. For example, we take a look at the relationship between 89 and 144, and that gives us a 0.618, or a 61.8% Fibonacci retracement percentage. 55 and 44 are 2 other integers within this sequence. The relationship between those 2 numbers is 0.382, or 38.2%. Another very common, one of the most common Fibonacci percentages that we talk about. 34 and 144, the relationship between those 2 integers gives us a level of 0.236, or 23.6%. We then take 23.6% divided by 61.8%, and what do we get? 38.2%. Again, The same relationship is 55 to 44. To make it easy, the standard Fibonacci retracement levels are as follows: 38.2%, 50%, 61.8%. However, less common, but I believe equally as important, are two other percentages: 23.6% and 78.6%. Now, why is Fibonacci best suited for the Forex market? The greatest amount of volume and participation in any financial market is the Forex markets. The 24-hour market does not experience any gaps, so it's seamless, where the market closes at 5 p.m. Eastern on day one, opens exactly at the same price the next day, 5:01 p.m. that day. Fibonacci is widely used in program trading as well, and it's recently become, over the past couple of years, very popular. So program traders, coders, will literally tell their algorithms to look for Fibonacci retracements. It's a little bit of a self-fulfilling prophecy as well. You know, if we believe that the market's going to find support or resistance at a certain level, the traders will place the trades accordingly, and maybe the market will find support or resistance at that level. But again, with the advent of program trading, there's more and more buy and sell signals that anticipate Fibonacci levels to be support and resistance. Now, how exactly can we use Fibonacci in our trading? It's best used in trending market conditions, where the market has a tendency to accomplish new highs or new lows over a given period of time. Yes, program trading is the same thing as auto trading. It's synonymous, one and the same. Once the market has established a significant trend, the Fibonacci retracement levels are used to project where the market may establish a new higher high, or a higher support level, I should say, or a lower resistance, a higher low or a lower high. Again, it's better used, or it's best used in trending market conditions. If we have a range-bound market condition, Fibonacci is not very helpful. But then again, you know, as we know, Forex traders make most of the money in trending market conditions. So we want to try to avoid range-bound markets, you know, just conceptually. So if Fibonacci levels do not hold, it's a sign that maybe we should not trade that pair any further. Now, here's an example. A trending market has a tendency to accomplish new highs or new lows over a given period of time. We draw trend lines, such as the white line here, to demonstrate that there's a general trend to the upside in this market. Now, the Fibonacci retracement levels can be very helpful, again, finding the trade entry once the market has established a trend. In an uptrending market, we begin at the bottom of the trend, which is the lower left-hand side of the chart. Always start on the left-hand side of the charts, and draw the Fibonacci tool to the top, from the bottom left to the top right. And we'll have charts to show exactly how we do this. The subsequent Fibonacci retracement levels then emerge, project where future support and resistance may emerge. In a downtrending market condition, it's just the opposite. We begin at the top of the trend, at the top left-hand side of the chart, and we draw the Fibonacci using the tool to the bottom right-hand side. The subsequent Fibonacci retracement levels in a downtrending market project where future resistance is most likely to emerge. For example, here's a trend. We start at the beginning of the uptrend, which is at the bottom, usually in the lower left-hand side. Where exactly? Well, it always depends on a chart-to-chart basis, but usually we look for the lowest low to identify the very beginning of that trend. And then we draw the Fibonacci line up to the top before we have a big retracement. What's considered a big retracement? Well, the Fibonacci will tell us that, actually. So take a look at the chart. It's the same chart as before, but now we drew the Fibonacci levels. Again, we start at the bottom left-hand corner. That's the beginning of the trend. This dotted black line shows us the Fibonacci tool from the bottom left-hand side to the top of that trend. The market then pulls back. These horizontal lines that emerge represent the Fibonacci retracement levels. You see, what Fibonacci does is it tells us that in a trending market, we know that when the market goes up, after it goes up, it'll retrace. It'll come back down. It's not going to come all the way back down, though. It's going to come down a fraction of what it came down. We'll establish a higher low. The Fibonacci percentages tell us where that low is most likely to occur. Traders will sometimes ask, well, which number is better? Is it better to look for a retracement to anticipate that retracement at the 23.6% level or the 38.2%? That we do not know. We use other tools to confirm that retracement, but we have an equal chance to touch either one of these levels, any one of these levels. 23.6, 38.2, 50, 61.8, or 78.6. Keep in mind, though, if we break back below 78.6, if the market retraces a full 100%, that's no longer considered a trend. Again, a trending market is a market that establishes higher lows and higher highs, or lower lows and lower highs. So logically, if we experience a 100% retracement, that's not a higher low. That's not a trend anymore. Now, extensions work in the same way, but to the upside, meaning Fibonacci projections, also extensions, it's the same thing, is very simply, we take the same percentages and we add them. We add them to a 100% move, meaning the market's gone up, that's 100% of the trend. It retraces. We now project above our high as the market makes a new high where the market's most likely to find new resistance. You see, the projections are used to find price targets. While the retracements tell us when to buy in an uptrend, the projections tell us when to take profits. It tells us both sides of the trade. In the example of a 38.2% Fibonacci level, the retracement is a 38.2% retracement from the high down. A projection is we add 38.2% to the top. It can be very helpful, again, in finding price targets. Once the market has completed a significant trend and has retraced to a Fibonacci retracement level, Fibonacci projections can then be used to approximate the new swing high, the best place to take profits. In a downturning market, the same holds true, but for the opposite, meaning new swing lows can be projected, meaning new lower lows. Here's how it works. We start again at the beginning of the trend. That's the former trend. We draw the Fibonacci tool on up. It's the same chart as before. The market retraces, and we know we found support at the 38.2% Fibonacci retracement level. Then we wait for the market to break out to a new high. Well, where's our price target? Where should we anticipate resistance? And again, there are a number of different Fibonacci percentages. We don't know which one it's going to be, but we know the market is most likely to find resistance at one of these levels. So the 123.6% Fibonacci level is very simply 100% of the trend plus another 23.6%. The 138.2% level is very simply, again, the length of the entire trend plus an additional 38.2%. 138.2% of the trend, so to speak. These are our price targets. So we can see at 61.8%, or actually 161.8%, the market eventually found resistance and reversed back down. The first sign of confirmation that the market will break out is very simply the market does break out. We make new highs. As soon as the market makes new highs, we then look to the Fibonacci projections to anticipate where that price target should be placed. Now, we can use Fibonacci with other indicators. It's a great way to find additional confirmation where we should try to buy or sell. Oscillators such as the RSI, which is the relative strength index, Bollinger Bands, MACD, moving average, convergence, divergence can be used to confirm suspected reversal points. In an uptrend, we wait for the market to retrace back from its highs to a Fibonacci retracement level. We then look for further confirmation of a possible reversal with an oscillator. You see, we use the oscillator to confirm which Fibonacci level is most likely going to will represent supports. Once the market has in fact established a new higher support level, we then again wait for the breakout to a new high. And as the market approaches a Fibonacci projection level, we use an oscillator again to confirm the price target, to tell us where the market top is. Here's how it works. Notice, in this example, the beginning of the trend is obviously at the bottom. We start at the bottom, we draw the Fibonacci tool on up to the top. We then pull back, the market pulls back, and we see Fibonacci levels. Which Fibonacci level? We don't know. But the RSI buy signal occurs when the RSI line crosses below and above 30. Is the RSI alone enough to use? I would say no. Should we place a trade at every one of these Fibonacci levels? I would say no also. But when you put them together, when the market's very close to this 50% Fibonacci level and the RSI line crosses below and back above 30, and we get a technical RSI buy signal, the two together give us a much better chance of actually catching the bottom, which, we're lucky that it did. Now, same chart, same buy signal. Now we wait and the market establishes a new higher high. It breaks out. Well, should we place an order, take profits at 23.6% projection, meaning 123.6 or 138.2? Not necessarily. But we know the market's most likely to find resistance at one of these levels. We use the RSI sell signal as confirmation. What's a sell signal? The RSI line crosses above and back below 70. The buy signal below and back above 30. The sell signal above and back below 70. So you can see here when we use the RSI in conjunction with the Fibonacci levels, it gives us a much better chance to identify the best place to buy and sell. And I'll tell you, this technique alone can be very, very effective. Now here's MACD, moving average convergence divergence. Now what I like to do is I like to use the histogram bars. And specifically what I like to do is look for the bars when they're making higher highs to start to accomplish lower highs, like there. Or when we're making lower lows, we start to accomplish higher lows. These turns on the top and the bottom of the MACD histogram bars, I think, can be very effective. So in this case, we see that the market pulled back. We had a 50% Fibonacci retracing level at this point. We know the market's going down, but we're looking for the indication of a reversal. Take a look at that bar, that candlestick. We made a higher low at the bottom, and over there, right at the point, that was the best time to buy. The market makes a higher high, breaks out, additional confirmation that we're right. We touch at 23.6, 38.2, eventually get to the 50% level. What was the confirmation to take profits? Right there. As the histogram bars established a lower high. Some traders actually even look at these flat tops as an early sign of divergence. Either way, I mean, that's just a nuance of the trade. But either way, we can use the MACD to look for further confirmation. Everybody with me so far? Any questions at all? I know that we're kind of going through this a little fast, and I don't want to lose anybody. Any questions so far at all about Fibonacci, projections, retracements, using the oscillators like the RSI or MACD? By the way, you don't have to use both, RSI or MACD. Just select one. It's more than enough. They're basically going to show you the same trade signal anyway. There's no need really to use more than once because they're related. Fibonacci and RSI are two different. They're unrelated. Fibonacci and MACD are unrelated. So, very good. Do I change the settings for the MACD? No, I do not. I always leave the standard settings for RSI, MACD, Bollinger Bands. I like to use the standard settings because I like to see the indications that everybody else sees. Again, the self-fulfilling prophecy. I want to know if everybody else is watching the sell signal. Okay. I'll show you exactly. Tomorrow, by the way, day 2, what we're going to be doing is we're going to be drawing Fibonacci lines on the actual live price chart. I mean, this presentation we put together so we have very good examples to show you. But we have more charts as well. For example, here's a Fibonacci and the Bollinger Bands. The Bollinger Bands, we know the center line is a 20 simple moving average. And we have 2 more lines which is basically that 20 simple moving average extended 2 standard deviations above and below the center. When we know that based on 2 standard deviations, 95% of the market's trading activity should statistically take place inside the 2 bands. So it's actually kind of unusual that the market touches an upper band or lower band. Most of the time, you'll notice we're right in the middle. We're not touching either band. So that's an additional sign of confirmation. Questions: are there extensions that are paired with retracements? If I understand your question correctly, it's a great question. Is there a relationship between a certain retracement and a certain projection? I've done extensive research in this. I have not found it. Meaning that if the market comes back down to the 50% level, does that mean we're more than likely to go up to the 150% level? I have not found a relationship. I'm sure, there are rules to speak to that, but I personally haven't found, any kind of rule that will tell us that. But again, we start, and this is exactly how you start with the Fibonacci. Start at the bottom, draw the Fibonacci level or the line, the tool, up to the top. We then know that the market's going to retrace to a certain Fibonacci retracement level. With the Bollinger Bands, we know that it's a good time, generally speaking, to buy when we're below the lower band. Now, in this case, we see the market in a move down was hugging the lower band through a couple different levels. So again, it's not a perfect science, but it does tell us statistically when it's a good time to buy. And conversely, the market breaks out. We touch the upper bands. It could be this band or it could be this one perhaps. But we know statistically, if we take profits a little too early, it's not the worst thing in the world. To be honest with you, I think that the oscillators like the MACD and the RSI, the previous examples, I think those are better suited to be used with the Fibonacci. I wanted to include Bollinger Bands because it's a very popular indicator, but we see how the market hugs the lower band over there and walks up the upper band over here. That's not specific enough. The RSI and the MACD, and if I had to select one, I'd probably say the RSI. That's very, very helpful in filtering out the Fibonacci trades. Now, Fibonacci certainly can be found in very common chart patterns. In fact, I always like to look for Fibonacci inside the chart patterns, such as, for example, triangle consolidation patterns, head and shoulders, flag and pennants. For example, Fibonacci is found in the symmetrical triangle. In a long-term uptrend and long-term uptrend to the upside, we know the market will fall into a consolidation pattern like this, and then eventually, more than likely, it'll break out to the upside. The market, generally speaking, I am of the belief that the market will eventually break out in favor of the long-term trend. But notice what happened. The market established the highest high at this point. This was the beginning of the most recent trend. We then retraced back to where? The 78.6% Fibonacci retracement level. By the way, when we're in a triangle, we begin to anticipate higher lows and lower highs, which again establishes a triangle. So once we see that higher low, we can then, and I know that I drew this trend line as follows, but we could also draw the trend line like this. It gives us, if we miss the first trade, it gives us a second trade. And eventually, with the anticipation of a breakout to the upside. What time frame do you draw the Fibonacci lines on? I find that they're more useful on longer-term charts, just because longer-term charts take more statistical information, statistical data, more trading data into account. Daily charts, I think, do very, very well. 4-hour charts. I don't like to use indicators very much below, I would say the minimum is a 1-hour chart. I'm not drawing Fibonacci lines on a 5-minute chart. I don't think it's enough information, and I think that the longer-term trends are certainly a lot more representative as well. But you'd be surprised. You draw the Fibonacci levels on 4-hour charts or 1-hour charts. You can find day trades from those levels. You can then go to a 5-minute chart and look for the trade. But the lines are drawn at the minimum as 1-hour chart, nothing less than that. Do we use pivot points? Well, pivot point, and there's a couple different definitions for pivot points, but generally speaking, the Fibonacci levels, the way we talk about it here, is my favorite approach. I know there's many, many other, approaches as well, but this is my favorites. Everybody know the famous chart pattern called head and shoulders? What's a head and shoulders? It's very simply a triple top where the center is higher than the first or third top. The rationale is that the market goes up, establishes a high, pulls back, higher low. That's a Fibonacci level right there. It establishes a higher high. Beautiful breakouts. But then what happens? We should logically establish a higher low, right? We don't. We come back down. This would represent a 100% Fibonacci retracement level. Not from the lowest low, but the new Fibonacci level, meaning over here. We went up, but we came all the way back down. If we were to draw the smaller Fibonacci levels here, we would know that we broke down below all of them. So that 78.6% level, which is the last one, that was a first sign that something's changed, that the uptrend has changed. Another way to look at it is we have that beautiful trend line, right? We draw a trend line like that, and we say, great, uptrend. Again, it's the same candlestick, no matter how you look at it. It was this big red candlestick. That was the first sign that something was not so good. The uptrend had changed. We established a low at the 23.6% level. We come back up, and the second shoulder falls very closely to the highs of the first shoulder, which is a rule of thumb. The next thing you know, the next big move is to the downside. How do you trade head and shoulders? I like to, once we've broken this trend line, remember that trend line here? Once we break that, then I say, uh-oh, I think that's the first shoulder. Then I'll immediately look for confirmation where I think the second shoulder will be. Where? Very close to the highs of the first shoulder. They're usually very close to each other. Okay? So we would sell here. We place our stops above the highs, above the high of the head, with a price target below. And by the way, what we can do is then use Fibonacci. We draw the Fibonacci level from the new high, the new trend. Here's the retracements. That's a Fibonacci level, starting from the top. Everybody see how that works? Head and shoulders is an excellent way to use Fibonacci, or Fibonacci is an excellent tool to measure head and shoulders. Here's Fibonacci in a flag and pennant. Again, long-term trend to the upside. We have a consolidation pattern. We start at the bottom. We start the Fibonacci line at the bottom. We draw it to the top. That's number one. We pull back. Number two, that's a 61.8% level. That's our flag and pennant. How did we know that the line was going to come down here? Well, it's usually very parallel to this line. Look at this high and this high and this high, and we draw the lines accordingly. We draw a parallel line. That's number two. And then number three is obviously the big breakout. And I actually like to label the charts with the numbers. One, the top. Two, the retracement. Three, the breakouts. Which brings us to my favorite part of the presentation, which is Fibonacci and Elliott Wave. Okay, let me go to this question before I go forward. What makes the angle like 30% or 45%? Well, it's a great question. When we're drawing these lines, if we're drawing a downtrend, and I know the long-term trend to the upside, but this immediate move is down, right? In a downtrend, I always draw resistance first. It's the most important level, because in a downtrend, that's going to tell us where to sell, and it's going to tell us where to place our stops. We sell a little bit below resistance. We place our stops a little bit above resistance. Okay? So we draw the resistance by connecting two significant highs. One high there. That's another high there. Then we know from this point moving forward, we know that the downtrend is there. The next step is we draw a support level. The support level oftentimes is parallel to resistance. So that gives us another way to project where support may eventually be. You see, the long-term trend is to the upside. So I'm anticipating we're going to have a retracement, and I want to buy. This level over here helps us project where that may be. So the angle, whether it's 30% or 45%, that will always be different. But start with a resistance in the downtrend or support if we're in an uptrend, and then anticipate a parallel line to emerge. It's a very easy technique to use. Now, who here is familiar with Elliott Wave? I love this stuff. Elliott Wave is a little bit more of an eclectic, subjective way to look at the markets. If you're not familiar with it, we're going to have a lot of fun. What Elliott Wave does is identifies impulse moves, meaning pro-trend, and corrective moves, which are more range-bound or retracements within a longer-term trend that develops over time. To answer your question, I always like to trade pro-trend, trade in the same direction as a long-term trend. But that means when we trade in the same direction as a long-term trend, what we'll do is we're going to counter the short-term trend. This is a long-term trend. And in fact, let's do this a different way. And I want to talk about this because this is at the very center of Elliott Wave. So we have a long-term trend. It's going up, right? That's a long-term trend. But a long-term trend, we know it's never just a straight line up. It's a move up, and then we have a short-term retracement. The green lines are short-term. Then we have a long-term move up in the higher highs. Then we have another short-term retracement. And then, of course, another move up. So we always want to trade in the same direction as a long-term trend. That's most important. But by doing so, where do we want to buy? Here or here. So technically speaking, we'll be trading counter trend, but counter the short-term, pro long-term. Our trade, the easy way to think about it is our trade should always agree with the long-term trend. It's true, we're going to want to buy low and sell high, so we're going to have to trade counter the shorter-term trend, but it should agree with the long-term trend. Does that make sense? And by the way, we have our long-term moves to the upside like this, and we have, let's make this red, and then we have a short-term retracement, and then we have our long-term move up, and then etc. Well, the blue lines, these are called impulse moves. This is Elliott Wave now. These short-term moves are considered corrective. Impulse moves are usually very fast. Corrective moves are usually consolidation patterns. So when you see the market consolidating, a lot of times it's pulling back and consolidating. It's retracing consolidating. Now, the basic rules for Elliott Wave, there's a couple rules we have to know. Number one, Wave 2 cannot retrace more than 100% of Wave 1. Okay? So here, this is Wave 1. Starts at the bottom, this is the top. That's 1. Number 2, and I'll make this red because remember, the 2 is corrective. The 2 cannot fall down more than 100% of 1. If 2 is lower than the beginning of 1, then that means it's not Elliott Wave. It's not Fibonacci. In other words, it's not a trend. Wave 3 cannot be the shortest, but oftentimes Wave 3 is the longest. This is Wave 3. Wave 3 starts at the end of 2. This is Wave 3. Whenever you see a market, and this applies also to the stock market equally, whenever you see a market that really just explodes, really fast-moving stock, it establishes new highs, and you're like, wow, this is a great trend. Chances are that biggest part of the trend, that's 3. When I look at a chart, and we're going to do this tomorrow, when I look at a chart, I look for the biggest part, the most significant part of the trend. And I immediately start to think, let's see if that's 3. Now, we're not going to be experts in Elliott Wave. It takes years and years to really, maybe not years and years, but it'll take some time to, get a better understanding of this. But just wanted to, talk about it a little bit because it's a nice, different way to consider the markets. Now, last but not least, wave 4, which starts at the end of 3, cannot retrace, or I'm sorry, cannot enter wave 1. Remember, this was wave 1. 4 cannot come down to 1. Not allowed. 2 cannot come down below 1. 4 cannot enter 1. You don't want a 100% retracement. And if you look at this chart at a very basic level, this is a trend. 1 goes up, retracement, a pullback. That's a Fibonacci level right there. We break out to a new high, Fibonacci projection. We pull back to 4, Fibonacci retracements. We break out to new high 5, which is considered the top of the trend, Fibonacci projection. Does everybody see how that works? So this is the beginning. We just identified this as 1. This is a Fibonacci retracement, Fibonacci projection. That's 3. Fibonacci retracements, Fibonacci projection. Fibonacci is the basic ingredients of Elliott Wave. All of these levels are Fibonacci levels. And by the way, once we hit 5, which is considered the top of the trend, we then enter a massive corrective phase, which is A, B, C. All of these angles are Fibonacci. After C, the pattern starts again and goes up, a new one. Now, here's Elliott Wave and Fibonacci putting all the pieces together. Wave number 1 is the first impulse move in the trending market, like we discussed. It's the lowest low. We look at the lowest low in the chart, and then also, by the way, this applies if we're talking about a downtrend. I just like to use an uptrend as an example because it's easier to visualize, and most of us think about stocks that go up. So wave 1 is the first impulse move in the trending markets. Wave 2 is usually a Fibonacci retracement of wave 1. Oftentimes I found it's a 50% or 61.8% retracements. Wave 3 is usually a Fibonacci projection of wave 1, such as 161.8%. Wave 3 is the most significant part of the trend and is always bigger than wave 1. Can never be the smallest. It has to be bigger than wave 1, and it's usually the biggest. Not always, but usually it's the biggest. Sometimes 3 and 5 are close to each other. Wave 4, which is over here, that's 4, is a Fibonacci retracement of 3, the prior impulse move up. And wave 5 is usually has a percentage retracement with 3. So that's 5. Yeah, start from the beginning. This is also very important. This is 3. This is 5. 3 and 5 usually have a Fibonacci percentage relationship. Sometimes they're the same. Sometimes 5 is 61.8% of 3. But they're usually related to each other. The market's very symmetrical. Once you start to consider the market this way, stocks, Forex, you're going to find these relationships emerge. It's fascinating how they do. Wave 5 is known to represent the highest high of the entire trend, but oftentimes wave 3 and 5 are double tops. And then the corrective ABC, B, C are also obviously Fibonacci percentages of the prior moves. Everybody with me so far? I'll stop here. Questions? I know it's a lot. You don't have to remember all these rules, but it's just the general guidelines to go through or to keep in mind. And I promise, practice this for this little while. Look at the charts and try to plot you know, the levels on the charts. And eventually you're going to have one of those moments where all of a sudden say, oh, I see how it works. It might not happen immediately, but it's very fun. Okay? Here's some examples. Wave 1, that's 1. Start from the bottom, we go to the first top. Wave 2 is what? The 78.6% retracement of 1. Wave 3 is what? It's a 78.6% projection of 1. It's actually 178.6% of 1. See how 2, or I should say 3, is almost twice as long as 1? It's actually 178.6% as long. Amazing, right? And then, of course, 4 cannot enter 1. Former resistance, for those of you in the cyber group, I talk about this all the time. Former resistance, new supports. Well, it has to be because if 3, I'm sorry, this would be 4. If 4 falls back inside 1, it's no good. Oftentimes, it'll come almost exactly to that point. Here's a bigger picture. Again, start at the bottom, that's 1. The retracement is 2. 2 cannot have a 100% retracement of 1. The bottom was over here, actually. 3, now we drew the Fibonacci lines on 2 to 3, meaning 4 is a percentage of 3. Just as 2 is a percentage of 1, 4 is a percentage of 3. 5, double top with 3. 3 and 5 are oftentimes double tops. And by the way, it looks like 5 is a percentage of 3. So everything's related. We have homework for you now. And of course, if there's any questions at all, please feel free to chat them in. But here's your homework. First of all, we're going to meet again tonight. I believe it's 8 p.m. Eastern. Tonight's broadcast will be a replay. I'll be here again. We're going to talk about the same things that we talked about today. But all we're going to do is replay it because there's a lot of our traders either overseas or on the West Coast. They might not have been able to join, us this early in the morning. So we're going to go over the same presentation again this evening. If you'd like to join us, we'd love for you to be here. Sometimes, you go through the presentation the second time, it's more things. Things are easier to understand. This also is being recorded as well. But here's our homework. Tomorrow, we're meeting again. On a daily chart, over the course of the night, search for a currency pair with a strong directional trend. There's quite a few of them now. I haven't looked at them recently in terms of Elliott Wave either, so it's going to be a little bit of a learning experience for both of us. But some currency pairs with strong trends include Aussie yen, pound Aussie, Euro Aussie. A lot of those Aussie crosses have nice trends. If it's range bound, like the dollar Swissy or the euro dollar, then we're not going to look at it. But look for a currency pair with a strong directional trend. Plot the Fibonacci lines on those charts, starting at the beginning of the trend and extending the Fibonacci tool to the end of the trend. Aussie Kiwi is another one too. Identify the possible retracement levels where the new support and resistance may be. So don't even go into the Elliott Wave for the moment. Just try to practice plotting the Fibonacci lines, and we're going to meet tomorrow. We're going to see if we come up with the same, buy and sell signals. Because again, the reason why we use Fibonacci is try to, figure out where to buy and sell. So try to come up with some suggested buy and sell signals. Adam, do you think we should buy the Aussie Kiwi here? Do you think we should sell the Aussie yen there? It's actually, I think they're both sells. But use the Fibonacci retracement levels to tell us where support and resistance may emerge, and the Fibonacci projection levels to establish a price target. On day 2, tomorrow, we're going to turn to the live charts. We're going to study the current Fibonacci levels. We're going to apply the theory. We're going to put the theory to practice. Question, how do we know if a trade makes sense, money management-wise, if we don't have an idea how far of an extension to expect after we get a retracement? Well, it's a great question. Let's go back to the chart. Let's go back to, where was my projection charts here? All right, so the projection levels as well as the retracement levels, this applies to both. They simply tell us where, when the market establishes new support, for example, we start at the bottom here, we go to the top. Now we're retracing back down. Where are we going to find support? I don't know. The Fibonacci levels tell us it's when support emerges, it's most likely going to be at one of these levels. See, without these levels, we have this entire length to pick from. Where's the market going to find support with? No idea. These levels narrow it down. So we have 5 specific levels to key in on. I'll use an oscillator for further confirmation. But as far as money management, and projections work the same way. The market breaks out. It's our first sign of confirmation. Which will represent new resistance? I don't know. It could be there, it could be there, it could be there. But that's at least a lot more specific than just somewhere, you know? So we use a Fibonacci to approximate what price levels are most likely to represent new resistance. The RSI is a great tool to use to look for further confirmation. As far as money management, I mean, when I think about money management, I think about not risking more than a certain percentage of our account equity when we enter the trade. And that decision, our position size, should be, determined beforehand. And obviously giving our protective stops a good amount of breathing room, a good amount of space. Don't use tight stops. They get stopped out very, very quickly, very easily. But to answer your question, as far as the projections are concerned, when the market, after it breaks out, I watch the Fibonacci levels and I watch the indicator at the same time. And I look for the market to touch a level, like over here it did. Let's start fresh. At this point, the market broke out. At this point, this was the breakout. We said, well, should I take profits here? We're at the 23.6 projection. Well, the RSI is just beginning to break out here. Let's give it a little bit more room. 38.2%, maybe, but the RSI is still going up. But what happened? At the 50%, that's when the RSI is turned back down. So are using these levels to see where they should go if the candles were not there yet. Exactly right. The way I like to say it is where the market's most likely to find support or resistance. Because at the end of the day, we really don't know. But it's most likely. The probability, the way I think about it is, when we have a Fibonacci retracement level, it's probably going to find, we're probably going to see support at one of these 5 levels. I think that's a lot better than just thinking, well, it could be anywhere between here and here. That's a lot of space. And the RSI might give us buy and sell signals all day long. At least now we have 5 big levels to contend with. And by the way, we didn't mention this, but another way to really confirm this, look for double bottoms and double tops on Fibonacci levels. This was not a perfect double top, but look for double tops and double bottoms on the Fibonacci levels. It's another great way to look for further confirmation. In fact, I really sometimes don't like to enter on the first Fibonacci, but I like to anticipate the double top or the double bottom. Yeah, so I mean, it's certainly can be very helpful. A couple quick reminders, by the way. We have a brand new website, mycybertradinguniversity.com. It's I'll type it in over here, my.cybertradinguniversity.com. City.com. It's our brand new free social networking site where we post trade ideas. A lot of it happens to deal with the Forex market, by the way. Every morning, relevant news. Sometimes we talk about specific currency pairs, things of that nature. It's free to join. If you join, invite me to be a CTU friend, a Cyber Trading University friend. More friends we have, the better. And again, it's like Facebook, but it's only about trading, so it's that much better. Moreover, we have a demo account for Forex traders. We have a demo account trading competition. And from our My Cyber Trading University website, there's a button over here called Traders Challenge. Click on that Traders Challenge button. That will direct you to our enrollment. You have to register for a special Forex demo account because all these demo accounts are being held separately on the special server. And then at the end of the month, every month, we look back and see who, was the best Forex trader, and we hand out cash prizes. The cash prizes are CTU dollars, Cyber Trading University dollars, that you can use to redeem for free online Forex courses. And it's free to join. If you've joined and maybe didn't have such a good experience, you lost some demo money, you want to start fresh, that's fine as well too. Okay, and all the enrollment, the details, the rules, all that good stuff is on the World Traders Challenge page. Again, all you do is go to my.cybertradinguniversity.com, that's the website right there, and click on the Traders Challenge button. In addition, we have cyber group mentoring in our live chat room throughout the day. Myself and Stephanie, we host the cyber group, and many of you are members there. We start at 8 a.m. Eastern, and we go throughout the day. We meet, very much throughout the day, 8 a.m. and then, noon. We do a full hour of Forex and options, Stephanie, as well as following the stock market throughout the entire day. So whether you trade stocks, Forex, or stock options, I think it's a great reset. It's a great resource. Trade ideas and education, we're there all day, every day. And in addition, we have a very special Forex course. And FXCM, Forex Capital Markets, being our marketing sponsor, has created a grant. Basically, they're going to pay for your course. So the course, which is normally $2,000, if you have a funded FXCM account, if you fund an account with $2,000, the course is only $20,000. You basically get to keep your money. Instead of spending on the course, just put it into a trading account. It's still your money. The course only costs $20. And, we have a very close relationship with FXCM, so we're very happy to, talk about this together. If you have any more questions about our course scholarship or anything else, I believe, don't hold me to this, I believe the UK accounts are also eligible. I'm not 100% though. The best thing to do is call our offices. Ask for Colin. He's standing by the phone right now, actually. Colin, what's your extension if you're still with us? I know you had a bunch of things to do. I think he's still there. What's your extension on your phone? You might be in a meeting. Ask for Colin. They'll send you right over. And he'll be able to determine if you qualify with the UK FXCM account. I think it should be okay. Colin, ask for COLIN. Phone number is 877-70-CYBER. Oh, and by the way, if you have any questions, or if you'd like a copy of this PowerPoint presentation, and we really have a lot, we have the entire Elliott Wave discussion and much more, we'll be more than happy to send you a copy. Just email us, forex@ctutrading.com. I'll leave this over if you want to take a screenshot of this or write down the information. I'll leave the slide on for a few minutes. But it's forex@CTU, Cyber Trading University, ctutrading.com. And we'll be more than happy to send you a copy of the PowerPoints. And I'll give everybody the website as well. Oh, this is the best. Sorry, this is the best phone number to use. Thank you for letting me know, by the way. 877-70-CYBER. 877-702-9237. And I posted that phone number in there. Thank you for letting me know. Okay, so yeah, email us forex@ctutrading.com or call us, ask for Colin. Anybody picks up the phone, we'll be more than happy to help you. And we'll send you over a copy of the PowerPoint, or if you'd like to see more information about our Forex course. It's a really great program. I'll be back here tonight, 8 p.m. Eastern, for a replay. We're more than happy to invite you for that as well. But if not, day 2, tomorrow, we'll send you a reminder email. We're going to apply everything we discussed today to the live charts, and we're going to look for actual trade signals, or trade signals. I want to thank you all very much for joining us. Great crowd, great questions. I love that you're able to join us here today. And I wish you all a great day. The best of luck. I'll give everybody the event calendar as well. In fact, I'll give everybody the link. It's 4:30 p.m. Eastern tomorrow. Okay? They can register for tomorrow's session. Again, we thank you for joining us. We wish you a great day. Look forward to seeing you back soon. Have a great day, everyone.